Welcome to Talk Tickers, your essential deep dive into the earnings calls that are moving markets. We cut through the noise to get you the core insights.
Yep, and today we are unpacking the fiscal Q4 2025 results for Digi International. That's ticker DGII.
The call was after the close on November 12th, and the market reaction was pretty immediate and very positive.
It was. So our mission today is to figure out exactly why. It wasn't just a simple beat. This was really a validation of a multi-year strategic pivot.
So we need to dissect the financials, the strategy around their big acquisitions, and, of course, the guidance that got investors so excited.
Exactly.
All right, let's jump right in. The numbers really set the tone here. DGII delivered a pretty meaningful beat.
A very meaningful beat, yeah. It confirms that whole shift they're making toward value-added IoT solutions is, really starting to accelerate.
So headline numbers, what are we looking at for revenue?
Record revenue, $114.3 million for the quarter. That's up almost 9% year over year.
And crucially, it beat the consensus estimate by, 3 or 4%?
About that, yeah. So the momentum is clearly there.
And then there's the profitability story, at least on an adjusted basis. Adjusted EPS came in at 56 cents.
Which was a huge beat. The street was at 51 cents, so that's, nearly a 10% surprise, and it's up from 52 cents a year ago.
When you deliver a beat on both top and bottom lines like that, it signals some real operational strength.
It does, but, and this is the big but, we have to talk about the tension in these results.
Yeah.
Because the adjusted numbers were great, but the GAAP EPS told a completely different story.
Right. GAAP EPS was only 26 cents. That's a decline of almost 19% year over year.
A huge decline.
So for the listener, what's the simplest explanation for that gap? Is this just, financial engineering?
Not at all. It's what you call pain for gain. That drop in the statutory GAAP earnings is almost entirely down to two things, and they're both strategic investments. First, higher operating expenses sales, R&D, as they scale up the solutions business. And second, a ton of acquisition and integration costs from that recent Jolt Software deal.
So they're spending money now to make more money later?
Precisely. They're solidifying the transition to a higher margin future, and that costs money up front.
That brings us to the real story here, which isn't just one quarter sales. It's that pivot to predictable recurring revenue. How did the ARR look?
The annual recurring revenue, or ARR, is the engine of this whole story. It was a record $152 million.
And the growth rate is what's really key here.
Absolutely vital. ARR is up 31% year over year. This is their fourth straight quarter of double-digit ARR growth. It proves the shift from selling hardware boxes to selling long-term software solutions is, it's working.
And you can really see it in the mix now. ARR is about 35% of total revenue. That's a material change.
It is. You're seeing a measurable difference quarter over quarter. It validates this whole push towards multi-year subscriptions.
And what about cash flow? Is this real money or just paper profit?
Oh, it's real. Very strong operating cash flow of $28 million in the quarter. That brings the full year number to $108 million.
Wow, and that's up about 30% year over year.
Yep. And that cash generation is so important because it's what fuels their M&A engine without taking on too much debt.
Okay, so let's shift to that core strategy. The CEO basically framed fiscal 25 as the year they proved the whole value-added IoT solutions idea worked.
He did, and central to that proof is the acquisition engine, specifically Jolt Software.
Let's drill down there. They closed that deal in August for about $145 million in cash.
Right, and it was immediately accretive. It added over $20 million in ARR from day one. And they've already slotted it into their SmartSense platform, which is in that high-growth IoT Solutions segment.
The speed is impressive, but what about the synergies? They laid out a target of $11 million in incremental EBITDA by the end of calendar 26. That sounds ambitious.
It is, but they have a clear plan. Some of it is operational, cutting redundant back office stuff.
The easy part.
The easy part. But the real strategic focus is on cross-selling. Jolt always had this bottoms-up approach, selling to, individual fast food locations.
Right.
Digi is now taking its big SmartSense enterprise sales force and aiming them at Jolt's customer base to sign larger, more profitable enterprise deals. That's where the bulk of that $11 million should come from.
Okay, so that brings us to the critical tension here, the thing the market is watching like a hawk, the segment performance, and really the margins.
This is the nuance, right? This is what separates the bulls from the bears on this stock.
The IoT Solutions segment is the growth engine, revenue up 23%. but the margins got crushed.
Crushed is the right word. The operating margin in that segment dropped a massive 640 basis points. It's down to just 5.6%.
So the market is asking, are we buying high growth, low margin integration risk, or are we buying high growth SaaS potential?
Exactly. And it's complicated by their traditional business, the IoT products segment. That part was only up 4% in the quarter and actually down 2% for the full year.
Customers are just working through inventory, I assume?
That's the story. After all the supply chain craziness, customers are finally normalizing their inventory levels, so they're buying less hardware for a bit.
So if you put it all together, gross margin is up, but operating margin is down. Can you just walk us through that contradiction one more time?
It's the perfect picture of the pivot. The overall gross margin expanded 280 basis points to almost 64%.
That's the good news.
That's the good news. It shows the mix shift to high-margin software is working. But the overall operating margin fell because those upfront cost sales, R&D, G&A, grew faster than revenue as they digested Jolt.
So the bet is that the gross margin expansion is permanent and the operating margin pain is temporary.
You've got it. That's the entire bull case in a nutshell.
Okay, looking forward. What's going to sustain this beyond the Jolt integration? Management was talking a lot about AI.
And this is where the long-term vision gets really fascinating. They talked about a long fuse vision for AI, specifically exploring tiny language models at the edge.
Tiny language models. That sounds pretty cutting edge for an industrial device company. What does that mean for a customer?
Think about speed and autonomy. Right now, a sensor on, say, an elevator collects data, sends it to the cloud thinks about it, and then sends instructions back.
There's a lag.
A huge lag. And it uses expensive central servers. The idea here is the model sits on the device itself. It's a tiny model that only knows about elevators.
So it can make its own decisions.
Instantly. If it detects a weird vibration, the model on the device can decide to, say, call for maintenance right then and there. No human, no cloud. It's faster, cheaper, and more reliable. That's a huge value proposition.
And they're not abandoning their core business either, right? They mentioned some new modems and frameworks.
Absolutely not. That connectivity hardware is the foundation. You need robust pipes to deliver the fancy software solutions.
Okay, let's get to the guidance, because I think this is what really lit a fire under the stock. For fiscal 26, they're guiding for 10 to 15% revenue growth.
Which is strong. But the critical number is the profitability target. Management expects adjusted EBITDA to grow 15 to 20%.
So EBITDA is growing faster than revenue.
That is the signal the market was waiting for. It's management saying, yes, the margin compression was temporary, the operating leverage kicks in now.
They're confident the Jolt costs are fading and that high margin ARR is going to start hitting the bottom line.
Correct. And it all ladders up to their long-term vision. $200 million in ARR and $200 million in adjusted EBITDA by the end of fiscal 2028.
And they hinted that more M&A could even accelerate that timeline. What does the balance sheet look like? Can they afford to do more deals?
It's in great shape. They paid down over $114 million in debt last year. Net leverage is in a very comfortable 1.3 to 1.5 times range.
So they have the dry powder.
They have the dry powder, and they're operating in a space industrial IoT that is incredibly fragmented. There are tons of targets out there.
And you have these big industry tailwinds, too. The whole build out for AI, 5G, data centers, that all requires the kind of networking gear DGII sells.
With a great backdrop. And all of this explains why the stock jumped over 7% after the call. Investors looked right past the GAAP number.
They did. They focused on the ARR scale, the strategic pivot, and that really strong guidance for fiscal 26.
And the sell-side analysts followed suit. Craig Hallam upgraded the stock to a buy, jacked their price target from $30 to $45.
And B. Riley went from 45 to 48, calling them an operational intelligence platform. So analysts are buying the transformation story.
Completely. They see it shifting away from a cyclical hardware model.
But with the stock up so much, 28% year to date, the valuation is getting a little stretched, no?
It is. It's trading near the top of its range, around 19 times trailing EV to EBITDA. That's not cheap for a hardware company.
Which tells you the market is already pricing in a lot of that future growth. It's assuming they execute perfectly on the margin recovery.
It's already giving them credit for becoming an industrial sauce business.
All right, let's pivot to our final segment. This is where we distill it all down. This is not financial advice, but it's the pitch we'd bring to the investment committee.
Okay, so our thesis hinges entirely on two things. Successful integration of Jolt and delivering on that promised operating leverage in 26.
And the skepticism, the reason the stock isn't even higher is that sharp margin compression we saw in Q4. Can they really turn that around so quickly?
So here's the pitch. We'd initiate a long position, and we'd set an aggressive price target of $52, which is well above where the analysts are now.
What's the catalyst to get there?
It's twofold. First, they prove the Jolt synergy execution happens ahead of schedule. We start seeing tangible margin improvement in the first half of fiscal 26.
And second,
the market re-rating. We argue that DGII needs to be valued not as an IoT hardware maker, but as a pure-play, high-growth, industrial SaaS platform. That category just commands a much higher multiple.
especially with the AI infrastructure tailwind.
Exactly. And the strong cash flow and clean balance sheet reduce the risk. It gives management the option to do more M&A, which could pull that $200 million EBITDA target forward to fiscal 27.
And if they do that, the stock deserves a higher multiple today.
That's the bet. We're betting on execution and the inevitable re-rating that follows.
It's a powerful argument. So to recap, DGII is really establishing its recurring revenue identity. The Jolt deal and the strong guidance are proof, but investors are, rightly watching the integration risk and the near-term margins.
Right. Management is confident they can almost double adjusted EBITDA by fiscal 28. So given their 40-year history, their strong balance sheet, and this fragmented market, here's the question for you to think about. What's the probability that another smart synergistic acquisition pulls that $200 million target forward to 27? And if they prove they can integrate deals that well, what kind of multiple should that command?
Something to mull over. Thank you for joining us for this deep dive into the DGII earnings call. Remember, this is analysis, not investment advice. We'll see you for the next Talk Ticker Deep Dive.